mighty crusade. Let not the keenness of our spirit be dulled. With thy blessing we shall prevail over the unholy force of our enemy. Help us conquer the apostles of greed and racial arrogances. Thy will be done. Pledge of allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Now the four-way test.
Is it true? Is it fair to all concerned? Will it build goodwill and better friendships? Will it be beneficial to all concerned?
You know what to do.
It is. We're sorry we cut off.
All right, glad we're having a good time breathing, everyone. It's time to get going. Thank you. Jeff Plaguey was appointed by Iowa Governor Kim Reynolds' position of Superintendent of Banking and began his service in September 2019. Previous to the appointment, Plaguey had worked in the banking industry for over 42 years. Prior to accepting the nomination, he held the position as President and CEO of Northwest Financial Corp. Of Arnold's Park. NFC is a two-bank, $2.8 billion privately owned financial services holding company. Plaguey is a past chairman of the Iowa Bank Association and the American Bankers Association and a former board member of Chicago Federal Reserve Bank, and has served on many other industry and non-industry related boards throughout his career. Plaguey currently serves on the board of directors for Northwest Financial Corp, Arnold's Park, and Northwest Bank in Spencer, Iowa. He also serves on the boards of the Conference of State Bank Supervisors in Washington, D.C. and American Bankers Mutual Insurance in Cleveland, Ohio. Jeff is a native of Latimer, Iowa. He received a bachelor's degree in agriculture business from Iowa State and is a graduate of the Graduate School of Banking at the University of Colorado Boulder. He and his wife Sandy live in Spirit Lake, Iowa. Without further ado, Mr. Jeff Plaguey.
Shorter than Kyle here, so we'll get down. Pleasure to be here. Thank you. And for some reason, banking seems to be of a higher interest these days than it was a few weeks back. So I'm getting a few more of these kind of requests, and it's a good opportunity to talk about Iowa banking versus some of the banks that maybe you've heard about in the East and West Coast and what makes them different. So I'm going to cover several things today. Yeah, I can push this ahead a little bit so I can see the screen.
Yeah.
There.
There we go.
So this is what I'm going to cover, and just talk a little bit about what happened over the last few months and what caused a lot of this drama. Some of the economic trends and banking trends that we're seeing, emerging issues, and then a big topic in banking right now is kind of fintech partnerships in banking as a service, and a little bit about that as well, because it has a little bit of tie back to some of the events that did occur. And hope they leave enough time for some questions as well. So this is a chart going back to 2001 of bank failures and total assets and bank failure size. And way off to the right is the three. The Silicon Valley, which closed, it was $209 billion, closed March 10th, followed by Signature Bank in New York on March 12th, $110 billion. And then First Republic of San Francisco, again, San Francisco, $229 billion. And I'll talk a little bit about all three of those, but and what caused those. But you can see collectively that they kind of set a record pretty fast. So the contributing factors on the growth or the failure was rapid asset growth, and I'll show a slide on that as well. Specifically with Silicon Valley, a very huge concentration within the customer base of venture capital and startups, and not only a concentration in the loan side of the equation, but even more importantly in this case, concentration in the deposit side of the equation. And huge depositors, uninsured depositors, tied to technology. We'll talk a little bit more about that as well. Again, high level of uninsured deposits, very large publicly traded banks, so they get a lot of action and news on an ongoing basis. Most of our Iowa banks are not publicly traded. In this kind of environment, that's a really good place to be. It's not in the news every single day. A lot of digital technology, social media played a huge part in the mass run on these banks, how fast it occurred, tied to technology that allowed that to occur. If you think about bank runs years and years ago, it was people going to the bank and withdrawing their money. These people didn't go to their bank and withdraw their money. They pulled out the phone, hit an app, took the amount, and the money was gone. And it was a very rapid pace. In fact, Silicon Valley was like $41 billion in 5 hours, with another $100 billion teed up to go out, which is why there was no chance that the bank was going to survive. And then significant increase in interest rates happening at the same time, which caused quite a difference in the bank's bond portfolios. There's a lot of discussion about that and what that actually means. And what it actually means in the simplest terms, if you were a consumer and you bought a CD back when rates were 2%, and it was a 2-year CD, if you ride that 2 years out, you're going to get your 2%. All of a sudden, now rates are 5% for that 2-year CD, so you have opportunity costs that you lost. You're still going to get your 2%. If you tried to get your money from that CD today, someone would pay you for it, and they're not going to pay you par. They're going to pay you something less because of that interest rate change. But just multiply, that's the banking industry. They all have bond portfolios, investment portfolios, and as long as they don't need the money, they'll get the return they put up for, and nothing goes wrong. If they need the money, they have to sell at a discount, take the loss, or it hits their balance sheet. That's when things start showing up pretty fast. And that was the case here as well. So how does it apply to Iowa banks, or how it does it not apply? The first is the asset growth. All three of these banks were rapid asset growth banks. The first one being Silicon Valley, 48%. They went from a $60-some billion bank to a $200 billion bank in a pretty rapid time. And again, it was tied to the sectors they were in. So, some of the investors, they would fund a startup. They would tell the startup, hey, we bank at this bank, put all the money there. That way we can help you manage the process. They have specific services for you. But again, when everybody's doing that and it's a small group of people, pretty soon you have a huge concentration. So you can see kind of the second line where the concentrations were. Again, we talked about Silicon Valley, but Signature had a little bit of the same thing, but also had some crypto activity tied to it, which caused a lot of uproar as well. And then First Republic, some will claim that First Republic was, they just got into the news at the same time with the other part, and so they became part of the problem. But when you read the report from the Fed and the FDIC and the regulators, the kind of the aftermath reports, there was issues going on at all three of these banks long before these issues showed up. In Iowa, you can see the asset growth is typically around 8%. That's slowing down as the economy slows down a bit now. Any concentrations in Iowa are typically tied to agriculture or commercial real estate in some cases. Uninsured deposits. This is the core of what hit those banks. And I've heard as high as 92% for Silicon Valley. I think there was one case where there's like 13 individuals that had $4 billion or 13 billion. I mean, it was just massive amounts of money there. At a $250,000 insurance level, that's a little bit of uninsured deposit coverage. And you can see his Signature was the same thing, 90%, First Republic 90%. The average bank in Iowa is 17%, and that's probably overstated because the only banks in Iowa that have to report uninsured deposits are banks $1 billion and over. And typically in Iowa, what you have is it's not any sector of the deposit base that has those. It might be some farmers, it might be some entrepreneurs, business people, consumers, and so you don't have that kind of concentration problem that happened to Silicon Valley where all of a sudden the news goes out, the bank may be in trouble, and all that money flees immediately. Large publicly traded banks, you know, if you're in the news every single day, you're gonna, some days that's good news and some days that's not so good news. And they had a bad run of bad news in a very short period of time. But you can see the average size of these banks compared to the average size of an Iowa bank of about 450 billion. We have, I'll show you the slide here later, kind of the overall mix of banks in Iowa as we go along. And then the bond depreciation. So what kicked off Silicon Valley is they were starting to have deposits flow out long before they hit the news because the fintech industry had kind of slowed down, that sector had kind of slowed down, so the businesses that were starting to withdraw their money for operating purposes. So that was already occurring, which then made them think about, well, we should probably, and they had taken all that huge deposit growth and put it in long-term bonds, 7-year bonds. And so that right before the market changed, so they invest at a very low rate, rates all of a sudden go up 5 or 6 or 7 times, and now they've got a huge loss in their bond portfolio. They needed the liquidity, so they had to sell it. They took multi-billion-dollar losses that hit the news, and that facilitated the panic from a lot of the investors and depositors there. So you can see they were 100, so they basically, on a tangible capital basis, had no capital if they had to cash out of that bond portfolio. You can see Signature wasn't quite as bad, First Republic wasn't quite as bad, and the average Iowa bank has about 20% bond depreciation. But a lot of, virtually almost all of our Iowa banks, those are held to maturity kind of, they aren't trading portfolios, they're just part of the liquidity of the bank. So it's also kind of a different mix of deposits and bonds as well. So that happens, obviously the fund, the deposit insurance fund takes a huge hit. Obviously the whole topic of uninsured deposits becomes a big topic. The last time the FDIC insurance coverage changed was back in 2010, right after the last financial crisis, and it went from 100,000 to 250,000. And back then, I've seen statistics that said about 80 to 90% of all deposits in the country were covered once that change occurred. Well, a lot of change happened in people's wealth, deposits, and so forth during that time, and obviously that number went down. But even today, by account number, 99% of accounts are still within the $250,000 coverage. It's a very strong concentration of folks outside of that. And a lot of times it's businesses, it's operating accounts. There's good reasons why they have more than 250. It's the business cycles that they're in. In some cases, it's other reasons they keep that kind of balance. So they undertook a comprehensive study and they released that report in May. And again, these are the estimated costs. So you remember the sizes. Silicon Valley, $20 billion, 22 I think is actually the number it ended up. Signature Bank, a bank half the size, but only $2.5 billion only. And First Republic, $13 billion. So a little story I think behind that as well is you're liquidating these banks is business models matter. In the case of Signature Silicon Valley Bank, the buyers looked at that thing and said, what are we buying? A very concentrated group of people that move their money quickly, why would we pay anything for it? And of course the value of that bank dropped sharply. So they did the study and they came up with 3 options on the $250,000 coverage. One is limited coverage. So the last time, again, they changed it in 2010. I was in part of those discussions. I was back kind of in the era when I was also in the chairs of the American Bankers Association. And there was a lot of us that were promoting at least index it. You're going to raise it, at least index it so it kind of keeps pace of some sort. I haven't calculated what that number would have been based on CPI or whatever. So keep the limited coverage just as it is, maybe change the number. This takes an act of Congress, literally an act of Congress. FDIC can't do this. After the last financial crisis, there was legislation passed that requires the Congress to get involved. I don't know about any of you, but I think the chance of that happening anytime soon is fairly narrow based on all the activities in DC today. Second, just cover everything. I'm not a proponent of that. I think it basically promotes bad behavior and concentrations on it, but that's part of the discussion. The only time I would support that would be, let's say the limited coverage amount goes to 500,000 in a change, if they ever get around to a change. I'd be a proponent of a two-tiered system. That for banks that want that kind of coverage, that want that kind of concentration, that have that kind of uninsured deposits, they can buy that insurance. They can do it today through reciprocal agreements, and maybe it's better if it's done through FDIC direct, and they pay an extra premium for it in order to get it, as opposed to assessing that across the entire industry, that cost. So I think there's ways that you can get better coverage. I'm just not a fan of just flat out unlimited. And then the last one, the targeted coverage. If you remember the stories back when, especially Silicon Valley was going down, there was this big uproar, and a lot of it was their clients who thought their money was going to be gone, because there was a lot of operating accounts in there, payroll accounts and everything else. So there's been some discussion about if a business has a non-interest bearing operating account that they use for daily operations in their business, potentially maybe that account should be covered 100%. I think there's some merit to that. They actually did that in the financial crisis. They called it the TAG program back after 2008, and did cover those kind of deposits for a short period of time. So that's the discussion now, and there'll be varieties and variations of that discussion going forward. But I just hope they actually get to the discussion at some point and actually really analyze it and factually look at. Don't react, be proactive about it, think about it, and do it right, as opposed to just making immediate change. But again, any abrupt change takes congressional approval, and that's going to be quite a battle. So the failure of Silicon Valley Bank and Signature was all happened on the same day, and it was I can't remember, systemic risk. So the FDIC does have authority to how to assess that loss, and they've chosen to assess it to banks over $5 billion in size. So you can see 95% of that assessment, that loss, which would be about $23 billion, is going to be paid by banks over $5 billion. You see 95 will be paid by banks over $50 billion. So that is specifically assessed to those banks, the larger, the regionals, in the nationals in that category. I don't think we'll have any bank in Iowa that will be impacted by this, because we have no banks with those kind of high level of uninsured deposits in the process. Now the other losses, Signature, our First Republic, that is going to be an assessment, and I think it'll go across the whole industry, because it wasn't declared a systemic failure. It was actually sold, and if you remember, JP Morgan ended up with it. So what have we learned from all this? And that's what I always try to look back when we see something like this. One is concentration still matter. The learning and education out of this one was, usually concentration discussions were about loan portfolios. This was not a loan portfolio. There was loan portfolio issues. This was a deposit concentration. So it was a new discussion about concentrations that hasn't been held in the past. Capital is still important. If you look at every failure, I've been in the business 45 years, if you look at every failure, what really is important is liquidity. You can have all the capital in the world, if you can't get to it, and you need the money, liquidity is going to fail you. And that's been proven crisis after crisis after crisis. And then business models do matter. As I mentioned to you, some of the losses kind of indicate what the buyer market thought was a good business model versus a bad business model. So new lessons, uninsured deposits need to be on the radar screen, and I think that should be across the industry. I think most of the attention is going to go to the regionals and the bigs, but even in the state level, we'll be looking a little bit more at that and what they're doing, not only in the standpoint of what percentage they have, but what are they doing to help customers that have more than an insured amount to be able to do it. And there's ways to do that. You can do it through reciprocal agreements today, or if you have $1 million, that bank can form an arrangement with one of the reciprocal companies, and they can put $250,000 in 3 other banks. And at the end of the day, your $1 million is covered. Now the 250 by itself is not really a number anyway. If you have a husband and wife have 500,000, you can structure those accounts to both are covered. There's ways to get more coverage even out of the 250 side of the equation. Social media matters. I have a son that lives in Berkeley, California, and Silicon Valley closed on Friday. He sent me a text on Saturday and said, the VCs are causing runs on banks out here. Social media was just wild. And of course, some of their interests might have been to get their own deposits covered, and at the end of the day, they did. But, combination of uninsured deposits matched with technology and the speed of technology and social media was an entirely new event than we've seen before. I don't know how you slow down technology. You can put some rules around it. If you think about how you wire money today in a bank, there's rules around that. There's authority levels, there's processes to go through. Some of the new technologies really don't have those kind of rules. You push a button and the money's gone. And so there probably will be some discussion about some of those new technologies, about how do you protect that kind of event from happening. But Matt's at with social media, and things get out of hand pretty fast. And the bank's time to respond is almost zero. If you don't have a plan, if you don't have the liquidity, with those kind of technologies and that kind of coverage, it's a pretty hard path to cover. So how you build your bank, how you structure your bank, how you structure your deposits, how you structure your concentrations really does matter, and it's gonna be a big part of the attention. Federal Reserve came out with a fund, and this gets to the bond depreciation. So if you try to get liquidity from your bond portfolio, you're gonna get a big haircut depending on the value of your bond portfolio. So Fed came out and said, hey, we'll cover it at par, no matter what the value is, because they can write it out if they have to take it as collateral. And so some banks have done that. It hasn't been as big as people anticipated. And I think some of it is the fear of having the government as a partner. There was this program called TARP back a few years ago that started here and ended up with all sorts of gyrations over there. And there's a lot of banks that said, nah, I don't want to play that game. This one doesn't have a lot of those terms. So personally, I've been suggesting to banks that think they need the liquidity. It's something they really should take a look at. It's a 1-year program, but it's actually a 2-year program because you can renew it up to almost the last day for another year. So, and those names eventually become public who did it. I don't think there's any bad provisions to it for banks that did it. I think it's just a smart play to get more liquidity at a time when liquidity looks important. Mergers and acquisitions. I'm going to talk a little bit about Iowa banks then. So this is an eye chart for those of you in the back of the room. But we still have 234 banks in Iowa. We're the fourth largest number on all the states in the country. I think Texas, Minnesota, Illinois, and Iowa. Now, that doesn't mean we have the most assets by any means. We just have a lot of community bank charters in the state of Iowa, which I think is a positive for those communities that they're being served by. But you can see we have 10 of them that are $2 billion or larger. We have 12 that are $1 to $2 billion. We have 65 in the $300 million to $1 billion, 99 and 100 to $300 million, 31 in the 50 to 100, and we have 17, I think, below 50. The reason for this chart is to look at the lines, and you can see where the concentrations are happening. And if you look anything below 300 million, that's where the numbers are shrinking. Some of that's because they merged joint banks within their holding companies. Some of it is they merged out of existence. And so, especially in those two bottom categories is really where we've seen a lot of consolidation. If you look off to the left, 2010, for instance, in that orange 50 to 100 million, we had 90 banks, now we have 31. And some of them grow out of a category, so it's a positive story as well. And I don't want to suggest that the banks in those lower categories are doomed, because we have very successful banks in those smaller categories. They just, the numbers itself, the scale. If you have a $30 million bank with 5 employees and you've got this regulatory regime coming at you that now is in banking, it's a pretty hard thing to keep up with. And that's what sometimes, and finding succession for those banks, sometimes if it's a rural community, finding people to move to that community, there's all sorts of reasons some of these banks merge out of existence. Obviously, inflation, every week, every month seems to be a different story. We're gaining, we're losing, we're gaining, we're losing. But right now, we seem to be gaining a little bit on it. Net interest margin. This is the biggest thing that, back to the deposit flow, when all this was happening with Silicon Valley and the rest, we saw no banks in Iowa lose deposits because of fear of loss of money. But what we are seeing is competition. There is a lot of competition in the deposit market right now. as there should be. The depositor has had nothing for about 12 years. And so they're rightly deserve a return on their money now, and they finally can get it. So that pressure now doesn't mean that deposits are leaving bank, but it's gonna cost the bank more to keep them. And so you're seeing that in the net interest margin. A lot of banks have term loans out on real estate, so they can't reprice those right away, so their deposits are repricing, their loans are not repricing quite as fast. Over time, depending on how long their portfolios, this will fix partly itself, but it does take time. This is the bank lending. You can see the categories of size above, but we have banks in Iowa that pretty much lend to every category. The category that's disappearing is consumer. And that's because everybody that sells anything offers credit anymore. And so it's hard to get a consumer to come to the bank to buy something when they get 4 credit officers at the car dealership or name the product. Everybody's got credit to offer in every segment. And you can see real estate lending is a big category for Iowa banks, in every category of that as well. Too fast on the button here. We still have 67% of our banks in Iowa that are considered ag banks. An ag bank is any bank that has over 25% of their loan portfolio in ag. So some would say that's not a concentration, others would say that's just the federal regulation. So we still do pay attention to ag. Obviously, grain prices are up and down depending on the day. We've had a pretty good run the last 3 years, a little bit less of a run the last few weeks, the last month or so, but a bump yesterday, I think, as well. And then a forecast of decline in ag income, but we're declining from a very high level. So I don't see that as a real risk right now. I see weather right now is probably our biggest risk in ag, which always is. There's pretty good crop insurance programs out there to protect ag. Land, how many of you own farmland? Just smiling every day of the week. There'll be some point of time where the smiles won't be as broad because time tells you that Newton's law still applies. What goes up will eventually come down. But it is wild right now. And I saw a figure yesterday that it's still double digits in Illinois, and I think parts of Iowa are still double digits, even in this economy. Real estate loans, I mentioned we have commercial real estate. These are kind of the sectors, the most prominent sectors for Iowa banks is multifamily, and construction and land development. That's really slowed down because of cost, and farmland, and then some 1 to 4s. Most 1 to 4s go into the 30-year fixed rate market. At least it was. Now it's maybe staying at home a little bit more. The economy is the economy, but this is the delinquency chart. Don't get hung up on all the individual colors. Pay attention to this here. Historically, if delinquencies are below 1%, it's a very healthy scenario, and it is unbelievable healthy. We just are not seeing those pressures. Now, I will say this from a couple standpoints. You can kind of see back in the crisis years where things got. Credit today, I mean, I think back in 40 years ago when I started my career in Webster City, Iowa, and somebody asked me who my competitors were, and I pointed to 2 banks down the hallway. That was my competitors. Now, every product, every service has thousands of competitors. And so, this doesn't mean the whole economy is healthy. It means the stuff that's in the regulated side of the industry continues to be pretty healthy right now. Bankruptcies are historically low. They're below, they went way down during the PPP, during the COVID timeframe, because so much money was flying around. And they have continued to be below the COVID rates. Starting to see a little tick up, but nothing alarming at this point yet. Office real estate is the biggest topic nationwide. And one of the measurements I saw recently was a cell phone activity study, which is really a fascinating study because that gets everything. That gets people in the office, people at the restaurants, people walking the streets, tourists, and everything else. San Francisco is still at 31% of pre-COVID times. Minneapolis is 51% of pre-COVID. The studies in Iowa show that downtown traffic here is about 87% based on the people count and so forth. Time will tell, but it does seem to be picking up a bit. So this office game, especially if you're in a metro market where you have to take taxis, cabs, public transportation, and all the issues that go with that, it is not coming back fast. My son, again, lives in Berkeley, works in downtown San Francisco. Fortunately, he wasn't on the train this happened, but one day a guy shows up on the train with a machete and running around the car. Well, if you're an office CEO trying to get people back to your office, you just lost a lot of ground that day if they public transportation. That's the real battle that cities have ahead of them. They have to figure out how to get the public safety back, encourage people to get back down. This is classified, these are loans, so we measure it two ways, as a percentage of capital. Right now it's about 12%, and as a percent of total loans, 2%. So these are loans that I have identified with some weaknesses. Doesn't mean the bank's gonna lose any money, but again, you can kind of look back to the last financial crisis in 2010. We had 52% of capital that was of loans. A lot of that was development, real estate kind of activity, 6% of overall loans. You can see we were bumping up a little bit pre-COVID, 3%, and now we're back down again. Something about $5 to $10 trillion flying into the economy seems to fix a lot of problems, at least temporarily. So it creates other problems long term, but it fixes the short ones. Emerging issues, succession planning. I spoke at a group yesterday with sustainable agriculture. Succession planning is an issue for everybody. I don't care what business you're in, it's a tough issue. And if you're in rural Iowa, it's a tougher issue to get people to move there. So a lot of these discussions center around. When I look at the banks that sell, that is the number one factor that I see, this lack of people to take it over. And sometimes it's family, nobody in the family, sometimes it's non-family. And so we really encourage our banks to work harder at that. Cyber and ransom, Silicon Valley, cyber was the topic, still is the topic, will always be the topic. It's just the world we live in today. Liquidity is a challenge for all banks, attracting and retaining deposits. Loan activity is still pretty good. You know, everybody wants to talk about a recession, but it's still showing pretty strong in Iowa banks. The politics of ESG, there's a lot of good things about environment, sustainability, and governance, but there's a lot of politics that gets wrapped around it, and unfortunately stops a lot of good conversations in some of those areas. And then continuing pressure on net interest margin is probably the biggest thing I hear from banks today. Last slide here, and we'll open up to questions. Again, we have some banks playing in the banking as a service, so there's a fintech somewhere around the country that has a specific service that the bank thinks that their customers might like, so they partner with that fintech, and all of a sudden they have 50,000 new accounts. And that all works great until something doesn't work great. And so the regulatory regime behind that, the due diligence behind what the fintech is you're partnering with, whether what they say they are doing is they're actually doing. So there's a lot of attention to this right now. And the Silicon Valley Signature and others have really jacked this up high. I think new partnerships are going to be hard for a while. And there was some activity of fintechs wanting to buy banks in Iowa and around the country as well. That got real hard for a while. Anybody that comes in and says they think they're going to sell their bank to a fintech, I said, well, I hope you have a lot of time, because it's going to take a lot of time to get it through the regulatory process these days. And again, for those of you, most banks in Iowa are state chartered banks. We have about 250 banks in Iowa. You saw the number, 234 are state chartered. So they are regulated by us at the Division of Banking. And if they're a member bank, we partner with the Fed. If they're a non-member bank, we partner with the FDIC. So there's two regulatory regimes coming at them, and then there's national banks which are regulated by OCC. So we switch off on exam cycles on those 234 banks, depending on who they're with. So with that, I will be sorry about my voice. This allergy smoke season is just wailing me, but happy to answer any questions. Steve?
Jeff, two quick questions. One, can you give us a quick asset liability management? Because it seems to me if Silicon Valley would have matched off the short-term deposits with short-term investments, it would not have been an issue. And secondly, we have examiners all over the place, from state to federal. Were they sound asleep?
So to the first question, asset liability management. How did they get so mismatched at Silicon Valley? For a long period of time, they weren't. Those deposits were kind of riding short, and they were not invested long. And then after about year 9, which we saw with a lot of banks, they just said, we got to get some return on this money. And so they went out and they went long. They initially hedged it. So they were doing it right initially. And then somewhere in the mix, they said, well, we need some profits. We got a lot of profit built up in this hedge right now. Unwound the hedge, and then of course the market moved again on them. And so, yeah, it is critically important for banks. If you're out making 10-year fixed rate loans with 1-year deposits or non-term deposits, and rates move, you've got a problem. Now you may not have a liquidity problem, but you're going to have an earnings problem, because all of a sudden your cost of money, think back to the savings and loan crisis, that's exactly what happened during those times. 30-year fixed rate loans with DDAs and saving account money. And all of a sudden, those accounts actually went to a rate much higher than they were getting on the loans themselves. If you look at the reports, Steve, back to the FDIC issued a kind of an after-the-fact report, and so did the Fed. There was a lot of activity going on in all these banks, a lot of MOUs, MRIs, memorandum of understandings, all those kind of issues. I think the criticism that's out there, and I think the criticism that the regulators recognize, is they did not hold people's feet to the fire to actually fix things. They just kind of kept kind of getting pushed out. And so I think that's the big change you're going to see. Every crisis has an outcome. Sometimes it's a regulatory regime, sometimes they actually get at some of the key issues. Some of the other sides is the staffing issues with these federal regulators, the same problems that everyone else is having. They were understaffed and not able to get in there. And so you are going to see it kick up. And it needs to kick up, although it can kick up wrong as well. If every problem is a one penny nail and a sledgehammer comes out for every one of them, that's not the right solution either. I mean, you've got to really pinpoint. One of the other topics I brought up to, especially the federal regulators, is when I started in banking, when we have a bank exam, they'd come in and do regulation, they'd look at compliance, they'd look at CRA, they'd look at all the regimes of regulatory coming at banks. Now all those are kind of separate departments. So you have a CRA exam, you have a BSA exam, and I think that has hurt the exam process, because I think they lose sight of, if you're a BSA examiner, Bank Secrecy Act, that's the most important exam in your portfolio. So you're pushing those issues to get fixed. Well, what really closes a bank, and is there enough focus on those kind of issues? So I think they have to answer those questions as well, as to whether they've kind of lost sight in that regime of what's really important and what really needs attention. Yes?
Do you think it would help if you moved from every 2 years to examination to 1 year?
So the regime we have in across the country, if you're a $3 billion bank or above, you're going to have annual exams. And if you're a problem bank, you're going to have annual exams. So we rate banks 1 to 5, 1 being the best, 5 being kind of on the edge. If you're a 3, 4, or 5, you're going to have annual exams. And so it is already in the process. Now again, as I say, for instance, at Northwest Bank, the bank I used to be CEO of, we're a state non-member bank. So we would have the state of Iowa in 1 year and the FDIC in next year. Now, we work together with these federal regulators, so sometimes we even have joint examiners on the exams, but that bank is getting examined every year. And that's because of the size. Or they're 18 months now, but they're about to hit through the annual.
So Jeff, not all real estate is created equal. You mentioned farmland, but there is some concentration of investor real estate. And even if a loan is performing, cap rates have gone up, vacancy rates are up. So when these loans mature and there's an updated appraisal, the values are going to be less than
Right.
when the loan was put in place.
Right.
So what is the solution, for those scenarios?
Yeah, one slide I showed, I think it showed 18% vacancy in downtown Des Moines. Well, there's a term they call ghost vacancy. Leases are still in place, but there's nobody in the building. Those leases, that building's most likely going to be empty when that lease matures. And so there is going to be a restructuring of that, and there's going to be some buildings that get converted into different formats, some buildings that aren't capable of being converted. The one thing I think is different this time, that's a terrible thing to say because nothing's ever different this time, but I look back 20 years ago when you look at commercial real estate, who was financing it, and it was primarily banks and insurance companies, and maybe a few others. Today it is spread all over the universe. I mean, there's venture funds, there's REITs, it's just, that may be the saving grace, the fact that it is so spread out over so many places. We have very few banks in Iowa because of the average bank size that are in office tower financing. It's just not their portfolio. So I don't see it as an Iowa banking issue, but to the broader picture, it's going to take some time to sort all that out, and it doesn't. If you did your initial cash flow and a purchase at a 3% interest rate and your vacancy's now 60% of what it was then, and now you have 8-9% interest rates, it's not gonna work. And so you either have to pour more capital in. There's been a lot of stories about companies that have sold off buildings, just take the loss and be done with it, let somebody else. You know, we had a speaker at the day with the superintendent that was talking about, you know, with every problem, there's an opportunity. They had a client that was looking to build a new building out in West Des Moines that was gonna be $400 a square foot. Happy to be a couple of buildings come available in downtown Des Moines, about $90 a square foot. And so, you know, some of those buildings will find new ownerships and maybe some less construction depending on, you know, there's A, B, and C. This commercial lender said if it's a C building, it's see you later, because it probably has.
It's gonna have to be it.
All right.
Thank you. And if I did cut anybody off who has a question, Jeff, would you be willing to stick around for that? Thank you. Okay, well, Jeff, thank you for sharing your time with us today and for your informative program. Much appreciated. As a token of our appreciation, we'll be giving a book in your honor to the Des Moines Public Library. It will become part of the Rotary Rosie Reader Van Collection. I don't know if you can see it. Something that our foundation was able to do in the form of a $40,000 gift to the public library a few years ago. Okay, for the rest of you, as you consider the following upcoming meetings, please think about someone you know who might be an outstanding addition to our club and bring that to these programs. It's a great way to give people exposure to the Rotary Club of Des Moines. Next week, we will hear from Balance Autism, Evelyn Horton. The following week, Doug Bickford from Alzheimer's Association. And then on June 29th, we'll do both the passing of the gavel, and we'll hear from First Lieutenant Tony Dormus from Civil Air Patrol. Okay, Kitty, always fleet of feet, was able to get me Beth Flannery's information. So for those of you who are, we're not going to be able to get the newsletter out before this occurs. So Don is hosting visitation from 2 to 5 p.m. at Hamilton on West Town Parkway in West Des Moines. And Celebration of Life is on Monday, June 12 at 11 a.m. at Grace Lutheran Church in Urbandale. Thank you to our guests for being with us today. It's always good to see you, Libby. Thanks for being part of the Rotary Club of Des Moines. Congratulations, Raymond. It's really great to see this come together. We enjoy giving money away, and we especially enjoy giving money away to people who end up working here and might be a prospect for our club. So give that some thought. We're proud of you and your accomplishments. Can't wait to see what your future holds. We are adjourned.